How I turned $21,175 into $502,656.23. Before we get into that, I'd encourage you for more financial tips to help you actually get money-making advice. Subscribe, smash the like button, and follow us here. Coming back to the topic, here are 3 things to help you get a chance at making a return on your money like this as well. Point number 1, ensure that you've identified what down payment requirements the product you're using has and what their implications are. What do I mean by this? Well, let's look at the numbers for itself, right? So if we're looking at some of the lowest down payment options, first of all, 3% down is going to be one of the lowest down payment options most lenders will make available. In this 3% down, realize that this is going to be limited to a certain loan amount. That loan amount is going to be the conventional loan limit, which is $647,200 here in 2022. Now, the most common understood down payment, lowest down payment, is the 3.5% down. This is going to be FHA, but do note this. FHA does have a standard mortgage insurance. It changes based on down payment, not credit score, and second, it changes based off of loan amount. So if you're going 3.5% down, once you get above a $625,500 loan amount, now your mortgage insurance is going to change from 0.85% of the loan amount to 1.05%. Well, what does this mean in English? Well, let's just use an example. Let's say here you are using a $620K purchase price, and here you're using a $650 purchase price. The mortgage insurance difference between these two, 1, because of the price, but 2, because of the insurance premium that's required above the $625,500 loan amount, is going to be $125.04. Now, the next down payment option that is one of my favorites is 10% down. This is typically the lowest down payment option you can go on most jumbo loans, which are going to be categorized anywhere from $647,200 or right above $647,200 to right above $970,800, which would be the county loan limit depending on which county you're at and if it's high balance or not. Lastly, the other option to look at is a notorious 20% down. This is a really great loan for most jumbo products, especially once you start getting to that higher loan amount. With this being understood, understand what down payment does the purchase price and the loan product I'm trying to get require, what implications will there be, what mortgage insurance premium options will have, what format of mortgage insurance is now available to me in light of this down payment. All those are first and foremost options you need to ensure if you're going to leverage a small amount of money into a bigger amount of money, going from one small down payment to a big one, because here is the key to real estate. It's all about leverage. See, in these numbers that we reviewed, realize that if you're looking at a $600,000 house, that's a $600,000 asset. Guess what? Potentially, assuming qualifications, you can get that $600,000 asset with 5% down. That's $30,000. You trade $30,000 of liquidity for a $600,000 asset. Being able to leverage small amounts of money for bigger assets is the way to make your money multiply. So now that we've identified using a small amount of money into leveraging for a bigger asset, the next step is going to be when to leverage this bigger asset for an even bigger asset. Right? In my personal story, buying a $605,000 condo with 3.5% down, we had to identify when should we sell and buy the next house. That was the key to trying to make this money work for me instead of me just always working super hard for more money. How do you do that? Identifying what is your comfortable monthly payment if you would move into that next house now, and comparing it to what will your payment be if you don't move into this house now, but later, is crucial. So to be able to illustrate this or go into more detail here, let's look at some figures. If you're looking at trying to buy a $950,000 house now, assuming qualifications, interest rate, let's call it 3.75. Your monthly payment is going to be about $5,012, and your out-of-pocket is going to be about $110,000 to be able to close on this $950,000. That $5,012 can be a big increase from where you're at right now. Again, assuming qualifications, let's now ask the question, what if I don't buy for 3 years? Well, according to Barry Habib and MBS Highway, based on the factors of supply and demand, they project that this $950,000 purchase price in 3 years is going to be worth $1.125, $158. Why? Well, again, the basics of supply and demand. When you look at the amount of homes available per 1,000 people in this 3.2 million total population, you see there are 2 houses available per every 1,000 people. This means that this year compared to last year, in this Orange County real estate report card, you're seeing 38% less houses on the market available for all these buyers. And what's happening, there are more buyers being pushed into the market of buying. As far as household formations, first-time home buyers, the projected amount here is 23,880 of them, entering into a market that doesn't have enough houses for them. What that means, in addition, is the amount of houses being built is 10,350. So we have an even less amount of houses being built into an already small amount of options, and we have more people trying to get these limited options than before. Those factors of supply and demand give the great confidence that these values will continue to increase. That being the case, and it's assuming that here, look at this purchase price from $950,000 to $1.125. Let's say rates go up by 1 point. 1 point in 3 years isn't too far off. Now your payment goes up $930 if you can get another $131,000 in cash to close. Let's assume that your house also is appreciating, your savings are growing, and whatnot. Let's point out this interesting factor here. When you're looking at this left option, this person to qualify based on 45% debt to income ratio, assuming qualifications, they're and no debt, they're looking at about $134,000 salary. To be able to qualify for this house, this same person has to go from $134,000 to about $158,000, assuming the same $158,468, assuming the same no debt except the mortgage payment at a 45% debt to income ratio. According to Orange County average in salary increases, this person would actually only be up to $155. Even with this extra $131,000, they could qualify for the house now that in 3 years, that same house, they might not be able to qualify for, even if they save more and keep working hard. Identifying that moment of when to make the move and leveraging your home based on what you're comfortable with, but also based on asking yourself that hard question. Are there any compromises that will allow me to make this move so I don't miss out is crucial. And having that conversation with people you trust, loved ones, financial advisors, financial coaches, your CPA, mortgage advisors to run numbers for you is going to be the clarity you need to make that decision and try to get the most return for your money. And the third point, compromise. What you want to do is you want to make sure you identify what options you can have, right? What are my down payment options? What are their impacts? Identify when you should leverage those things. And then from there, make sure that the filter you're using in these decisions is not just emotional, and it's not just trying to pinch every single penny you can, but is being able to try to find that right balance of what can I do, what should I do, and what can I compromise to be able to make sure it gets executed. We did not initially want a condo. Didn't seem to fit what my family's needs were. We found one that was good enough. And from finding a condo good enough, close enough to the location we truly wanted. We saw this 605 condo where I put 3.5% down, leverage into a home that was just appraised a little while ago for 1.4. And all I've used have been the proceeds from that house that I bought with a 3.5% down payment. And the good news is you can too. Because if you're anything like me and you're seeing that train of affordability start to pass you by in the city you want, being able to jump in where you can with responsibility, with clarity, and with the right compromises that put you still in a responsible situation, being able to jump on where you can is going to give you that opportunity that I had that has now created a great return for me. Do your research, run your numbers, speak to your advisors, and identify the best moves for you. Leave a comment here. Let me know your great stories if you've seen homeownership be able to produce this for you as well, and ask any questions you might have. Thanks so much.